which is, okay. Hey guys, live, Brooke Villano, and I'm going to go live on TikTok now. All right, we're going live. So, hey everybody, we are live. We are going to be talking today about the VA one-time close, buy land, and build using your VA home loan benefit. So, this is a question we get a lot of interest in, and the reason we get so much interest is because everybody wants to know how to buy land and build. Everybody's got a dream to build their dream home, and it's totally understandable. Especially with those of you that are using your VA home loan benefit, and you can't find what you're looking for. Oftentimes it's because you want land and you want to find acreage and you want to be able to build something and you want to build exactly what you want. And when you go out and you look for new homes in whatever price point you're looking in, you often find homes in communities on really small lots, because that's how builders develop lots. Sometimes you can find neighborhoods with larger lots, but usually you're looking at a brand new home community and the builder's trying to maximize their money. And in order to maximize their money, what do? They develop these really small lots. So typically that's why most people are driven to go look at buying land and building like a custom built home. That's exactly what they want, how they want it, with the builder that they want, on the piece of property that they want. So the cool thing is there's been a lot of development and evolution of the VA loan program. We didn't always have the VA one-time close, which is the custom construction loan that finances buying a piece of land, finding a builder, and building the property, building the home. So we're going to talk about that today. We're going to talk about the details of how do you use the VA one-time close custom construction loan. What do you need to know? How do you qualify? How does the builder, what do you need to do to get the builder approved? What types of property can you finance? And what does the process look like? So first of all, let's start with what is a VA one-time close? So there's, VA one-time close is different than a VA regular loan on a new construction home. So you want to make sure that you know the difference, because you might not always need a custom construction loan or a VA one-time close custom construction loan to finance what you're looking to finance. Sometimes a builder is willing to build you what you want on either their land or land that you find, and they're willing to finance it. And honestly, if you can find a builder who's willing to finance it and build what you want on your piece of property, go for it. Do it all day long, because that builder is carrying the financing of the construction. So whatever interest is being carried, because most likely they're getting a loan, most likely the builder's not financing it with cash out of their pocket. So if the builder's financing the construction and they're willing to do that and they're willing to build the house how you want it, go for it. That's the best deal that you can get. Just make sure you're protected on your contract. And in order to make sure you're protected in your contract, you need to find a real estate agent who is knowledgeable and understands the VA loan and can negotiate your transaction the way you need them to negotiate it. If you need a specialty realtor, and you do want a specialty realtor, you don't just want a realtor who hasn't worked with many military families and worked to negotiate many VA transactions, because that is very important. There's a lot of unique things that can be done with the VA loan that can't be done on a conventional or an FHA loan. So that is important. But if you find a builder who's willing to finance the construction, that's the difference between a non-one-time close custom construction and a one-time close custom construction. If it's not a one-time close custom construction loan because the builder is willing to finance the project, then we would call that just a takeout loan. You're just doing the financing once the house is completed and you get the builder permit or the occupancy permit once the house is fully done and the loan closes. Your VA loan closes right afterwards, but you're not financing anything during construction. The loan we're talking about is a VA one-time close, where the builder's not willing to build you what you want and finance it. And most builders aren't, because that's an extra added risk to the builder. Because if they build you the exact house that you want and then you walk away from it midway through the transaction and they're financing the project, they're stuck with this house with, black walls or pink walls or blue, whatever colors and whatever selections you make. So that's why a lot of builders are like, yeah, I'll build you what you want, but you have to finance it. And if you're financing it, you're using a custom construction loan. So there's a lot of people that think that there is no such thing as a VA construction loan. A lot of banks don't know about this program. A lot of mortgage brokers don't know about this program. So all the time we hear people say, I was told there is no VA construction loan. So if you're being told there's no VA construction loan, it's because whoever you're talking to has misinformation. They don't understand that there is a program. They don't know how the program works. And or their mortgage company, bank, credit union, whoever they work for, like Navy Fed doesn't have this program, Veterans United doesn't have this program, USAA doesn't have this program. I bank with that Navy Federal. I have my insurance through USAA. So I'm not a hater. And I used to work for Veterans United. I ran their Washington State branch for Veterans United. So I'm not hating on any of those guys. They just don't have access to this loan program. So if they're telling you it doesn't exist, it's because they don't have it. So the program does exist. We're closing them consistently. Every month we close a handful of the VA one-time close custom construction loans. We've got, I don't know how many going right now. And you can build a lot of cool things like multifamily, barn dominiums, manufactured, modular homes, stick-built homes. So we'll get into that in just a minute, or a few minutes, because there's a lot of stuff to cover. So the VA one-time close is where you're going to be able to go find land. So you can find land, and then you can find your builder, and then you have to get your plans that you're going to build. So you're going to have to either find an architect and have the architect draft your plans, or a home designer. Home designers are often able to design plans, but they're less expensive than an architect. Or you could find a builder that already has a set of plans that they're willing to build for you, and you don't have to have the plans drafted, so it saves you a little bit of money. You can also go online and you can find plans on architectural websites. There's a lot of websites out there. You can find already designed plans. Just know, if you go with a plan that's already designed, there is a chance that you will have to have it engineered or, altered for your local building authority in whatever area you're in, because there's different snow load requirements or different wind requirements or earthquake requirements or other things depending on what part of the country that you're in. So engineering has to be engineered for the local requirements. So just know, if you find your plans online or you find your plans from the builder, those things have to be done. So that could pose some additional cost to the plans. But how does this work? So you're going to find land, you're going to get pre-approved, your builder has to be approved. So let's kind of walk through that process chronologically speaking. First thing you're going to do is you're going to want to apply with a mortgage lender, a VA loan specialist that has access to the VA one-time close. We are a mortgage company. So I am the CEO of a mortgage company. It's called Veterans Lending Group. We go by VLG. We lend in 33 plus states across the country. We are adding licenses every single week. We've applied for all 50 states, but we just transitioned to our own mortgage company in January from a large retail mortgage company. The reason why we transitioned, so that we could offer quicker closings, better interest rates. We could have our own company, and the employees of our company could benefit from being a part of a smaller company and not some big giant mortgage company. And our clients, you guys get to benefit because you're not a number. We really care about our clients. We want to make sure you're taken care of. 65% of my staff are prior service or military spouses, and we want to make sure we do the right thing by you guys and take care of you. So VLG, our mortgage company, does offer this loan program. I am not doing this education specifically because we offer the program and I'm trying to have everybody work with us. We're offering this because we want to educate our military community. Unfortunately, our military community does not understand how these benefits work. And there's very few people out there educating with accurate information. So that's why we're here, to give you real answers and no bullshit, right? You guys have seen my bullshit bulletins. We're always trying to call out liars or people who don't know what they're talking about. So yes, the VA one-time close, it allows you to buy land and build. The first thing that you need to do is find your lender. You need to get pre-approved. The pre-approval process is fairly simple. It becomes more detailed and more cumbersome after the pre-approval, but your pre-approval is going to be filling out an online loan application. This takes 10 to 15 minutes. It's pretty simple. We don't even require that you know all of your debts and all the payments with your debts. You don't need that information. We pull that from your credit report. You really just need your name, social, date of birth, address. We need to know who you work for, approximate dates that you started working for those employers. Basically, we have to have a 2-year work history and a 2-year address history. So for those of you that are active duty, that's really easy. And then for those of you that are no longer active and have gotten out, then, obviously a 2-year history, we just have to piece that together. So our team can help. If you have any questions, we can help you walk through that. But basically, it's pretty easy. You go online, you complete the loan application. As soon as you've completed the loan application, it notifies us that the application is completed. Now, most mortgage lenders should have that same notification. So it's going to notify your mortgage lender that the loan application has been completed. Our team will get to work on it. If you're working with us, our team will get to work on it right away. We will start working up your income and your assets. We will need your most recent income document. So your most recent LES, if you're active duty, or your most recent 30 days of pay stubs if you're no longer active. If it's VA disability pay, we usually can get that from your certificate of eligibility and your bank statements. Social Security income, disability pay, those things can come from your bank statement. So if you're self-employed, we need 2 years of tax returns. If you have child support income, we need to document that. We will need a copy of your divorce decree, your child support order. Like those things are all typical regardless of what loan program you're using. You have to provide those documents, okay? So don't stress over it. And W-2s. I don't think I said W-2s for 2 years. So our system will allow you to upload those documents directly to your file. And then when we get your file electronically, we start working on your file. We're going to work up your pre-approval. We're going to be able to say to you, okay, here's your maximum ceiling limit. So this is how much you can go up to. And then we reverse engineer that and work backwards. You're going to figure out what payments are comfortable to you. We're not here to push you to buy something that's uncomfortable. We're here to we're here to educate you as to what your options are. We want you to make the decisions. We want you to feel comfortable with what you're doing. So the loan application gets worked up. We're going to tell you what your ceiling limit is, and we're going to issue a pre-approval. We are going to factor in some of the soft costs, what we call soft costs or costs on the construction loan. Now, the construction loan costs with our current construction loan are very minimal compared to a lot of other companies and what they're offering for construction costs. So you're going to have draw schedules. You're going to have a draw fee for an inspection because when the builder's getting more funds from the bank to continue the construction project, the bank or the mortgage company, us, we have to send out an inspector to make sure that the work has been done before we release more funds. And that's to protect you and to protect us. We want to make sure that your builder is doing what they said they were going to do. They're following through. They're completing the project. They're not taking the money we give them and going and finishing somebody else's home. Okay. So real quickly, let's talk about minimum credit score. I saw that pop up just a second ago. The VA custom construction program does have a minimum credit score. It is going to be 620 or above. Now, the regular VA loan does not have a minimum credit score. A regular VA loan, the VA handbook was written, and it does not say that you have to have a minimum credit score to use the regular VA loan. And when I say regular, I mean the house is already existing. It's already been built. If you're going to build a home, you have to have a 620 or above. And we need to get an automated loan approval to be able to issue a pre-approval on your loan. If we don't, for some reason, get an automated approval or your credit score isn't high enough and this is what you want to do, then we are going to communicate with you. We're going to go through running a scenario and saying, okay, this is what you need to do to get your credit score over 620. And this is what we think you need to do to get an automated loan approval. So we're not just going to turn you away and say, sorry, you don't qualify, you're shit out of luck. We're going to say, here's the plan and here's what needs to happen to get you there. And we're going to do this for free because this is what we do. We are in the business of helping our military families. We are not in the business of just making money. Okay. So obviously we need to keep the lights on, but we're not here to get rich off of you guys. We are here to help our military families. That's where our heart is. That's what we care about. So we are going to walk you through and guide you through the process. So if for some reason you don't qualify right now, we'll tell you that, okay, here's this other option you could buy using your VA loan for something that's already existing, or here's what you need to do to make it happen to get qualified to use your VA one-time closed custom construction loan. So we've issued your pre-approval. Now the next step 2, after your pre-approval is issued, step 2 is you are going to go start looking at land. You're going to get an idea of what land costs because now you've got a budget and now you can start working backwards with your budget. So you are going to want to work with a real estate agent. And here's why. Unless you have a family member who's selling you land and you don't need to go find land, you're most likely going to work with a real estate agent because even if you found a for sale by owner, the seller pays your realtor's commission. So a VA buyer is not allowed to pay your agent's commission. And when you're a buyer, your agent's called the selling agent. So you're not allowed to pay your own real estate agent's commission. It has to come from the seller. So it doesn't make sense for you to use the seller's agent, because if the seller has a real estate agent and you come in saying, I want to save money, I don't want to use my own realtor, then that real estate agent actually gets paid double the commission, or their half of the commission plus more, typically, when there's no buyer's agent involved. So get yourself a real estate agent. It will protect you. The real estate agent's job is to go work for you. Their job is to go arrange, find you the inspectors, find you if you need a environmental study on the land, their job is to go find the engineer, do research, get reviews, get good references, manage the project, manage the inspections, help you do all that stuff, do research on the property, make sure that the value is there, pull comparable sales. That's their job. So let the real estate agents do their job. And I can say this because I've been a real estate agent in my career. I've been doing this for 22 years. I've been a real estate agent for 3 of those 22 years. And there's a lot of value in using a real estate agent, okay? So when I do my own real estate transactions, when I am purchasing something, I use a real estate agent. I have my real estate license. I could do my own, but I use a real estate agent because, first of all, I don't have time for that shit. Secondly, I'm not up to speed on all the contracts and all the laws and all the requirements, all the things that are required. So get a real estate agent, have them help you start looking at land. So when you find a piece of land that you think you like, this is not the place that you want to immediately write an offer. Not necessarily, okay? Because you still have to find a builder and you still have to get the builder approved. So we'd like you to wait on writing an offer on land unless you write an extended land contract. So meaning like an extended closing. What would an extended closing be? 75 days, 60 days plus for sure. And when you're writing a land contract, you're asking the seller to give you time to do, there's different terms for this, but I'll give you some of the terms that I know this in different states because every state calls it something different. A due diligence study, a feasibility study, a contingency period. These things are all the period of time that you're contractually allowed to be researching the land to make sure that the water company can bring water, whether it's a well or connecting water to the property. The sewer can be connected for what you want to accomplish, unless it's like right there at the street already and you already know it's there. The septic can be installed without a massive extra cost because of the drain fields and everything else that is involved with the septic. To make sure, like we had a piece of property we bought and we were renovating it. So there was already a house on it, but we still had to do an environmental study because there were wetlands on the property. This was in Graham, Washington. And we had big pond in the backyard. And there was all kinds of elk and animals that came through our backyard all the time. It was a beautiful piece of property. But we had to do a wetland study. So we had to pay an engineer to come out, an environmental engineer to come out and mark off the wetlands and tell the county who required the study to issue permits, tell the county where the house could sit. So we paid $3,300 for this environmental study. So those are some of the fees that you might pay up front out of pocket, depending on the piece of land that you find. Now, you can find land where all of the studies are already done and you don't have to pay for those things. But a lot of land is raw land, nothing's been done, no studies have been done, and you need to figure out that you want to make sure that you can build on it. So that's what that period of time is that's feasibility, due diligence, or I don't know what else they call it, contingency period. So during that period of time, you don't lose your earnest money deposit if for some reason that land is not buildable or it isn't buildable for what you want to build on it. Okay. Let's say you want a 6,500 square foot home. You can only fit the footprint of a 4,500 square foot home. Then you want to know that before you buy the plans, get the builder, and lose your earnest money on the property because you're moving forward. So that's the protection of that due diligence feasibility period. Another reason why it's important to have a real estate agent writing the contract for you so that you make sure you're protected. Okay. So step 1, you get pre-approved. Step 2, you start looking at land. Step 3 is if you've written an offer on land, then obviously step 3 is you start the feasibility period and you start doing those studies. If you haven't written the offer on land yet and you want to find your builder first, I think it's a really good idea because finding your builder is when you get down to brass tacks and you really figure out how much is it going to cost me to build what I want to build. because oftentimes what happens is we have a misconception of what we can build for the cost. And then we end up getting into it. And then we end up, getting a set of plans and sitting down with the builder and going through all the specs. Now, what are the specs? The specs are, what kind of siding are you using? Are you using hardy board siding? Are you using wood siding? Are you using metal siding? Are you using a wood roof, like a shingle shake roof? Are you using cedar? Are you using composite roof? Are you using a metal roof? Like, those are the specs of the home. And the specs of the home matter because, number one, it affects the cost to build, right? Builder needs to know what materials are going into the home, because when the builder's pricing out a home, they have to call their lumber yard and their vendors and suppliers and window company. And they have to figure out, are you using hurricane-proof windows because you're in Florida or Alabama or in a hurricane-prone area? Are you just using regular windows? Are you using black vinyl windows or white vinyl windows? Like, all of those things do matter. And we need to know those things before we submit for your appraisal. So step one, you get pre-approved. Step two, you find land. Whether you put it under contract or not, you're finding land. Step three is you're finding your builder. Or you could put step two, you could make step two, you're finding your builder and then find your land. Those two can be interchangeable. Just make sure that you give yourself an extended closing if you do put a piece of land under contract, because you're worried that it's going to go away if you don't get it under contract, okay? So you find a builder. What does the builder have to be approved for a VA loan? What needs to happen, okay? So there's two different approvals that a builder has to go through. Number one, the builder has to go through the VA approval process. Only one time, and the VA approval process is very simple. This is the one that people are like stressed about because builders don't know what the VA requires. But the VA requires a handful of documents be signed by the builder, and most of the documents are like equal opportunity documents. Like, I'm an equal opportunity employer and I'm an equal opportunity builder and I'm not going to discriminate against people. That's most of the VA documents. So it's very simple for the builder to be approved through the VA, and it's pretty quick. So we will help with that. We can send the documents to your builder. We can have conversations with your builder. We'd love to talk to your builder because it really honestly makes the process more fluid. The more we have communication with everybody, your real estate agent, your builder, you guys, anybody else that's involved in the process, the more we can influence the success of the transaction. It's when we're in the dark and not everybody's playing nice in the sandbox and the builder doesn't want to talk to us, or they don't feel like, we're worthy. Sometimes builders and realtors don't feel like the lender's worthy of the conversation. And to be honest, that's hilarious to me because I've been a real estate agent and I've also worked with builders. And, there's a lot of control that comes with the financing of the transaction. That's where a lot of the magic happens. It's kind of the nucleus of the transaction, any real estate transaction, to be honest. So take it for what it's worth. And that is not throwing shade on real estate agents or builders. I'm just saying, like, it needs to be a partnership where everybody's working together. And that's how you create a smooth transaction. So we find the builder, we sit down with the builder, and we get the builder VA approved. The second, and when I say sit down, I mean like electronically, because, we're not where every builder is. Where are we financing? I'm going to throw that out there a couple times. We are in 33 plus states right now. I think we're in like 33, 34 states. We have applied in all 50 states, but we're not quite there yet. So my team they're on here, they're mediating or moderating, and I'm going to have them go ahead and start listing the states that we're approved in. But we are currently approved in 33 states. If we're not approved in the state that you're looking to build in, we can absolutely get you connected with somebody in that other state that we're not approved in, okay? Texas, we are approved in. I'll just run through the ones I know real quickly. Texas, Alabama, Florida, Georgia, Idaho, Washington, Oregon. I'm trying to go geographically now. South Dakota, North Dakota, Nebraska, Oklahoma, Kansas, Missouri, Mississippi, Louisiana, Minnesota, Wisconsin, Iowa, Illinois. There's a lot of states. New York, we are not approved in yet. I keep seeing New York pop up. We're not approved in New York yet. New York is kind of one of those funny states where, they can ice you for like 2 years. Tennessee, yes. North Carolina, yes. South Carolina, yes. Virginia. We're working on Maryland. We're close to having Maryland. We get a lot of questions on that. Arkansas, yes. Texas, I saw, yes. Michigan, yes. Connecticut. Oh, that's my team, actually. There they go. Alabama, Alaska, Arizona. So take a look there. Indiana, yes. Ohio, yes. Hawaii, not yet. We need a loan officer in Hawaii. So if you guys know anybody who's good in Hawaii, we actually need a physical person sitting in Hawaii to get our Hawaii license, and we'll get that turned on really quick. So getting the builder approved. They have to get VA approved, and then they have to get approved with our construction management company. That's not super complicated. It's not super difficult. If a builder's building custom construction projects, they're used to having to get approved by the bank. This is a very normal thing for the industry. So don't let them blow it up and make it bigger than it is. If you start feeling like you're getting resistance from a builder, pass them off to us and let us have the conversation with them, because we can oftentimes, it's just a matter of having the conversation or set up a three-way call so we can be on the call all together. So we're here to help you guys. This is not something that everybody just has information about. We don't expect you to know all the things, but we're here to be able to mediate, be a liaison, assist in whatever capacity we can. So builder gets approved. Once the builder's approved, then we can start working towards the transaction, meaning we can go into underwriting and get an underwriting loan approval, and we can get the plans and specs, which we're going to need in order to order the appraisal. The reason why we need to order the appraisal is because we need to determine what the future appraised value of the project is. And we can go up to $4 million on a construction project. And yes, we can finance multifamily up to 4 units. Anything over 4 units is considered commercial, okay? In any loan program, it's considered commercial, and you can't finance it with FHA, USDA, conventional, or VA financing, okay? You have to get like a commercial loan. So up to 4 units with your VA loan. And there are some restrictions there, or not restrictions, but some things to know. So we'll go into that in just a few minutes when we're talking about property types. So up to $4 million on your project. So you meet with a builder, you already have land picked out, or you have the builder picked out, you get the builder approval, then you go shopping for land. Once you know what the builder's approval is going to, once you know the builder is approved, and then you know what your project is going to look like, then you can really start digging in and figuring out what your budget looks like, okay? So the builder's giving you like an estimate. Usually they start with an estimate, and it's like, okay, it's going to be about this much price per foot. And then once you have plans to them, fully engineered plans, then they can actually give you legit costs on the construction project. And you're also going to have to sign a contract with the builder. So we want to make sure there's certain stipulations on how the contract's presented and how it's signed. So we want to make sure that we have to have a copy of the contract anyways, and it goes in the package with the builder approval package to the construction management company. The construction management company, they're the ones making sure that the builder's building the home according to how they, presented it in the specs and the contract and with the plans. And then they're the ones approving the draw releases. So the money getting released to the builder so that the builder can continue to build the home. So the construction management company is important. So the builder, now you're through step 3. You've gotten pre-approved, you found land, you found a builder, whether you find it in that order, whatever, and you're under contract for your land. Now, if you already own your land, then you skip that step and you go straight to finding the builder. If you already own your land, you go straight to finding the builder. And when you have found a builder, then we go and get the builder approved with your land, okay? Owning your land is great. You can use some of the equity from your land towards your construction loan if you need to. So like, for instance, if you own another home using your VA loan and you need to make up your entitlement difference, you can use the land to be credited towards your entitlement to make up the difference. And we'll get into that a little bit more in just a couple minutes. So you found the builder, you've gotten a budget from the builder, and the builder's giving you an estimated cost. And then also you've determined what specs you want in the home, what siding you want, what kind of flooring, what your, how your cabinets are going to look in the kitchen, whether you're using granite countertops or Corian or like whatever, quartz. So once you have all of that, then we can actually order the appraisal. Okay. So at this point, we are ordering the appraisal from the VA appraiser through the VA portal. We don't pick the appraiser, you guys. The appraiser is picked by the VA. We send them all the documents. They go out to the land and they take pictures of the land and then they combine that with the plans, and they do what's called a future appraised value. So they're saying once this construction is completed, this is what the house will be worth. Okay, that's a future appraised value. And they're doing the appraisal based on plans and specs is how they call it. So, and it's because we're going to close on the loan before the construction even starts. So we actually close on the construction loan. You lock in your interest rate for your 30-year term or your 15-year term before we actually start construction. So this is how the loan works. In that 60 to 75 days from the time you write an offer on your land to the time that you close, we're working on all these things. We're working on getting the builder approved. We're working on getting the plans and specs. We're working on submitting that to the appraiser. We're working on getting the appraisal back. You're working on any land studies that need to be done to make sure that this land is good to go and that it's exactly what you need in order to move forward. And we're doing all that work. So once you've gone through your feasibility and you're good to go and you know the county is going to approve what you're doing. Now, typically, we haven't started permitting yet. Some people will go ahead and pay for permits out of their pocket and start the permit process, and that will all depend on how long permits are taking where you're building. Some places are taking 30 to 60 days for permits. Some places are taking 6 months to get permits. So that can be 6 months can be really difficult because we only have 11 months to build the project out. So if that builder, if it takes 6 months to get permits, that builder has to be able to finish that home in 5 months because there's a whole nother process that has to happen if the house is not completed within that 11-month period of time. So how does the loan work? So what you're doing is you are financing a one-time close. Unlike a lot of construction loans, which are considered two-time closes, where you finance the construction project separately. Those are usually interest rates based on prime plus a margin. A construction loan typically requires that you put 10 to 20% down of the entire project, 10 to 20%. And that's why this VA program is so amazing because it's truly a zero down loan. So if you are doing, the construction project as a two-time close, then you also have 2 sets of closing costs. And this is usually what you're going to find from your local banks. They're usually going to say, we've never heard of a VA one-time close. We don't know what that is, but we have a construction loan. Here's our construction loan, prime plus a margin for your construction. Once the house is completed, we'll refinance you into your permanent loan. And then they say, yeah, you can refinance into a VA loan at that time. But the downside to that is you have 2 sets of closing costs. You have the closing costs for the construction loan, and then you have the closing costs for the final loan. And in some states, that could be really expensive. Like Florida, for instance, where you have to pay intangible taxes every single time you do a loan and doc stamps, it can get really expensive. So if you don't have to do a 2-time close, this one-time close is a one-time deal. The other downside to a 2-time close is that you have to qualify for the loan twice. So you have to qualify for the construction loan up front, and then once the house is completed, you have to qualify for the financing on the permanent loan. So if anything changes with your job, or if your income changes between when the house is started or when the construction loan started and when you go to get into your permanent loan, you could no longer qualify. And that's not a good situation to be in. The one-time close, you qualify up front prior to closing, and then you don't have to qualify again unless you go past 11 months on your completion term for the construction. But if you complete it within 11 months, there's no second qualifying. The other thing is appraisals. If you started with a construction loan and the appraiser says this future appraised value of this home is $550,000, and then you get done with the construction and everything's completed and the new appraisal is being done for your permanent loan, and the new appraisal says, actually, I'm coming in with a value of $525,000. Guess who comes in with a $25,000 difference out of their pocket? You do. The bank's not going to finance that. So that's the other downside of the 2-time close is there's risk involved with you potentially not having the bank honor the terms of the original agreement at the very beginning. And we don't like that. We like more security and certainty that this is going to be the terms of the loan. So that's the nice thing about the one-time close. The other really cool thing about the one-time close is you are not allowed to make payments during construction on a VA one-time close. The VA loan program does not allow it. Credit score requirements for this VA one-time close are 620. A regular VA loan does not require a 620 minimum credit score. We look more on a regular VA loan. We look at your credit history, and we want to make sure that you haven't had any late payments in the last 12 months. We want to make sure your debt to income ratios are in line. VA requires that you've paid your rent on time and that you haven't had any major lates in the last 12 months. and that you have job stability and income stability and all that stuff. But on a construction loan, there's a higher risk to the bank and the mortgage company and the investor. So the investor overlays that minimum credit score requirement, and they require a 620 credit score for this one-time close custom construction, okay? You can roll closing costs into this construction loan. The builder would be paying your closing costs, and the house has to appraise for that, right? So oftentimes one-time close, when you're doing a custom construction project, you have more equity in the project than you would if you were just buying something that a builder was building, because the builder's gonna sell that home for the maximum that the market will allow them to sell that home for. On a custom construction, they don't drive that. They don't get to control that. You're controlling that based on what you're building, what finishes you're putting into the home, what the appraisal comes back at, and the builder just can't mark it up last minute and say, ooh, there's more equity in there, I'm gonna make another 10% off of this buyer. That's not even an option with a one-time close. So with a one-time close, VA does not allow you to make payments during construction. On a regular construction loan, you're required to make interest-only payments during construction. And interest-only payments during construction can be costly. So you save money during the construction. Now, if you're one of those people that's like, I have money in the bank, I don't want to finance my interest, because basically what you're doing is you're rolling the interest towards the end of the loan and you're putting it into the loan. If you don't want to do it that way, then you can just come in with a down payment. You're allowed to come in with a down payment on this loan. You don't have to finance 100%. You can finance what you want, and we just structure the loan that way. So lots of flexibility. I mean, really the name of the game, VA transactions, you've earned this benefit, and the VA wants to make sure that you can use the benefit the way you want to. And we helped build this construction program with this investor. It's the number one wholesale investor in the entire company, and we were the ones working with them to get this program built. So, and I'm not saying that because it's like, ooh, look at us, we did this. I'm just saying, like, we made sure that they built the program the right way for our military community, and it was done the right way. And that's why we have the multifamily, because nobody else has the VA one-time close multifamily, which is super dope. Because if you can use a 4-unit or a 3-unit or a 2-unit, you can build that. You can use income from those other units to help qualify. You can also use income from those other units as income to offset the mortgage payment. So that's why the multifamily is so cool, because you're creating, long-term real estate for your portfolio, zero down and brand new construction. When you have something that's brand new construction, the cost to maintain is less expensive. You have less issues, hopefully, with the construction, less issues with the furnace, or you won't have to go in as a landlord and replace things so early on. Usually you have, a life of 10 years with most appliances and most major systems in a home. So that's why new construction is cool with the multifamily. And just because multifamily is a great opportunity for you to have as many doors as possible. And you don't have to have landlord experience to build a multifamily. However, you do have to have reserves. Reserves are money that you have in the bank left over after you build the home and you close on it. The reason why they want you to have 6 months of reserves with a multifamily is to make sure that, you're going to be living in one unit, but you're going to have other units in the home. If it's a 2-unit, you'll have one other renter or one renter. If it's a 3-unit, you'll have 2 renters. If it's a 4-unit, you'll have 3 renters, tenants that live in your property. You're required to own or occupy it, with it being a VA loan. VA's requirement is that you intend to occupy it as your primary residence, and you occupy within 60 days of closing. Now, when they say closing, they mean completion of construction. And it's 60 days or a reasonable period of time. So let's say you're actually active duty and you're going to be PCSing to the duty station where you're building, but your construction's completed August 15th, and you don't actually get your orders, don't have you arriving to that new duty station till December. VA would approve that, because we're looking at a reasonable period of time. Usually if it's less than 6 months, it's a reasonable period of time. Okay. So VA does require that you occupy, but the rule is that you have to intend to occupy as your primary residence, and you have to occupy within 60 days or a reasonable period of time from closing. It does not state you're required to occupy for the entire term of the loan. So you will see a lot of people that have a VA loan, they occupied the property, they lived in it, and then later on they turned it into a rental property and they moved out. And that's one of the things that makes the multifamily so powerful, is it gives you the ability to turn that into a multifamily investment property. And on a conventional loan, a civilian would have to put 20, 25, or 30% down to buy a multifamily. So beautiful. It's a great option, especially in a lot of markets across the country where you can't find multifamily. You know, there's a lot of places you can't even find a multifamily because the market's saturated and there's not any inventory. And what you want to do when you're looking at multifamily is you want to look at what can you get for rent and what's your mortgage payment going to be? And does it make sense? Can you cash flow it? If you can't cash flow it, can you make up the difference? I have clients that have bought multifamily 4-unit properties, and it's amazing what they've done, because sometimes I had this one client, I remember in Lacey, Washington. This guy was active duty. He was at JBLM, and he bought a 4-unit for $300,000. This was years ago when you could buy a 4-unit for $300,000. And his interest rate was like 5.25%, and his mortgage payments, I think, were like $1,700 a month. And he lived in 1 unit, and every unit he rented out, I think he had one at like $850, one at $900, and one at $750. So the 3 units were making the mortgage, the entire mortgage payment. He lived in the 4th unit for free. And then after a year or so, he moved out. He turned it into a rental property, and he had 4 cash flowing units paying the mortgage off, and he was making a net profit over and above that. So if you don't have landlord experience and you're going to build a multifamily, and we're going to try and use income from the other units that you're renting out to offset the mortgage payments to help you qualify, then you're required to use a property management company to manage those units. Okay, that is the VA's requirement. If you don't need the income to offset, then you're not required to use a property management company, and you can manage it yourself. It's not a bad idea to use property management company. You can find and negotiate with property management companies to charge you less because you're a veteran or you're military. But you want to make sure you find the right property management company. That's important, because you can find shitty property management companies just like you can find shitty lenders and shitty realtors, and like they all exist, right? We're all human. And that's why it's important to do your due diligence, do your research, figure out where you can. Our website, just further information, because I'm seeing questions coming across. Our website is VALoanBish@VLGnow.com. So VALoanBish@VLGnow.com. The company website is VLGnow.com. And we are the contact information, phone number 448-400-2429. You can text or call. And just remember, when we do these lives, we get a lot of inundation of a lot of contacts, a lot of people reaching out. So we will do our best to get back to you as soon as possible. We will get back to you. Thank you for your patience on that. And we'll get back to answer questions and schedule a time to talk, or just, give you the information that you need. So that's talking about the pre-approval, finding land, finding a builder. What's the builder have to do to get approved? There is a small builder approval fee. I believe it's $300 to get the builder approved. And once the builder's approved, they're approved for like a year, which doesn't matter to you because you're probably only doing one construction project with them. But if they're already approved through us, then it's nice. So we do have some builders that are already approved through us, but obviously the United States is big, and it depends on where you are, and it depends on where we're doing our construction loans currently. You can also, to find a builder, this is a question we get asked a lot, like, how do I find a builder? So we can help you with that as well. We do have some barn dominium builders. It depends on what state you're in and where you're trying to build a barn dominium. Let's talk a little bit about property types now, because that ends up being a big question. So obviously you can build single family. Single family is a stick-built house, okay? We're working on our California license. We are licensed in Pennsylvania. California, we should have very soon. We're in our final stages of approval. So we're hoping to have that within the next couple of weeks. I totally lost my train of thought. And sorry, you guys, I got distracted. So property types. Single family homes. Single family homes are just a regular stick-built house, and it's single family means fee simple, and it means that you own the land and you own the airspace above your house, okay? Why does that matter? Because with a condominium, you could have a townhome that is condominiumized. Townhome means it's attached it could be on the end, so attached on one side, or it could be attached on two sides, right? That's a townhome. A townhome can be fee simple, which means you own the land and you own the airspace above. A townhome can also be condominiumized, which means you own one. If there's 100 units, you own 1/100th% of the condo association, okay? Condos are handled differently than single family fee simple, okay? Or townhome fee simple. But yes, you can build a single family. You can build a townhome if you're attaching it to multiple units and you're doing like your 3-unit and it's townhome style, meaning it's up and down versus like a flats, like flats over in Europe. Flats would be the entire unit is on one floor. There's modular homes. Modular homes are not manufactured homes. Modular homes are considered fee simple or stick built fee simple. Modular homes are basically treated like a regular single family home. Modular homes are where the home is built in sections, pre-built in sections at the factory, and then it's brought on site to the building site and it is assembled, okay? Manufactured homes are like a mobile home, you might hear it, a manufactured home. That's where it's also built at the factory, but it's brought on a truck, almost fully assembled, minus the marriage line. The marriage line is where if it's a double wide, the 2 units are married together with the marriage line, okay? And it's got wheels on it. Mobile homes, manufactured homes are titled as personal property until they are placed on land on a permanent foundation and the title is eliminated. That's why you see special requirements for manufactured home financing versus modular financing, because modular is placed on a foundation and it is built, assembled on the property and assembled like a single family. Manufactured homes are put on a truck, semi-truck, and brought to the land and then installed onto a permanent foundation, and the marriage line is attached, and that, you know, whether it's a 1-unit, 2-unit, or 3-unit, that marriage line is brought together, and that's what completes the manufactured home on land. But the manufactured home does have special requirements. So we can do financing on any one of those, okay? Barn dominiums. Yes, we can finance barn dominiums. Barn dominiums have a couple small specialty requirements. Barn dominiums can be, you know, barn dominium is like a really broad statement or broad terminology, because a lot of barn dominiums just look like a barn, but it's a single family home and there's nothing different about it than a regular house. Some barn dominiums are built with steel siding and steel framing, and they're built, the engineering of the homes are very different. So we need to know more details about these types of projects. Barn dominiums can oftentimes save you money in the construction, but it depends on the construction materials, okay? And barn dominiums are allowed by the VA. We do have to find comparable sales, and sometimes the VA will allow you to use a single family regular stick-built house as a comparable sale to a barn dominium. The requirements that we have been told by the VA is that you cannot have, the shop cannot be bigger than the square footage of the home, okay? So the completed home. So you can't have a shop that's 4,000 square feet and then have a home that's 1,000 square feet. The home has to be bigger than the shop, because they don't want it to be mostly a garage with a little bit of living space, or mostly a shop with a little bit of living space. They want it to be a residence, and you can have a huge shop in it, but the shop has to be less square footage than the house itself, okay? You also can't be intending to have a business in the shop, okay? So you can't be like, I'm a mechanic and I'm going to have my mechanic's garage inside my home. There's ways to make that work. A lot of people want to shop because they want to work on the cars or automobiles or vehicles, or they want to have a welding studio, or they want to be able to have a woodworking shop, or like whatever it is that you want to have. But those are the requirements. So we don't want to have you submitting files that are proving that, like, okay, we're moving our mechanic shop into the property. So VA does not want it used for commercial purposes, okay? These are residential loans meant to be your residence. That's basically the biggest thing with barn dominiums. Otherwise, they're not as complicated as most people think. The VA doesn't have a problem with them. Our investor doesn't have a problem with them. And yes, there's a lot of beautiful barn dominiums. They're amazing. Like, some of them are gorgeous. Let's talk about container homes. I've seen some really incredible container homes on like social media, pictures and video of them. And right now, the VA, we need to get more clarification from the VA because the last time we were told container homes are not currently an option. I do believe, though, if it was a container home like the one I saw, that is basically just as nice as any other beautiful, fee simple, stick-built home, we could probably get an approval for it. So if it's something that you're like dead set on building a container home, let's dig in on your project a little bit more and let's really understand what it is that you're trying to accomplish. And then we'll have to get with the VA and we'll have to see if that's going to be approvable. They are making a lot of moves and changes quickly on these things because the VA one-time close is becoming more popular of a program. Comps, comparable sales, is very important to any property type, whatever you do. You can do a log home as well. Tiny homes, the property has to be at least 400 square foot or larger. Okay, so minimum of 400 square feet. I think tiny homes technically are smaller than 400 square feet, but you can use the VA loan, but you have to be able to find comparable sales, and that can sometimes be challenging depending on where you're building. If you're building out in the sticks in like Montana or Wyoming or whatever, and there's just not a lot of comparable sales, they'll have to go further out for comparable sales. So things to remember. And while I'm on it, Montana, I actually grew up in Montana. I absolutely love Montana. I grew up in the Bozeman area of Montana. And the appraisals right now in Montana can take up to 21 days for VA appraisal. So that's another reason why those extended closing dates make sense. Okay. So we've talked about manufactured homes. We've talked about modular homes, barn dominiums. We've talked about stick-built homes. We've talked about multifamily. Let's talk about qualifying if you currently have a VA loan, okay? If you currently have a VA loan, there's two things that we have to look at. Or if you have a mortgage and you own a home, there's two things that we have to look at. So we need to, first of all, we're qualifying you before the construction starts, okay? So we need to qualify you to be able to qualify at the time of closing on the construction loan, which means if you're not selling your house prior to the completion of the construction, then we have to qualify you with your existing home. If you have a VA loan already on your existing home, then we have to figure out your entitlement that's available because you have to have enough entitlement to be able to finance this home. If you don't currently have an existing VA loan, with the new Blue Water Navy bill that went into effect in January 2020, there no longer is a county cap for the VA loan, okay? So if you're wanting to build a $4 million house anywhere in the country and you're not using your VA loan and you credit qualify and income qualify, feel free to build a $4 million house, zero down, okay? There's no longer a county cap when you don't have a VA loan. The only time the county cap comes into play is if you have a VA loan outstanding and you're using that person's entitlement that has a VA loan outstanding. Now, some people have multiple VA loans in their family. Both spouses served, you're currently using one VA loan, you have the other VA loan available, use the other VA loan because then you can keep the house. Now you have to qualify with the mortgage payments. Okay, so if you are not planning on selling that house, then you do have to qualify with the mortgage payments. But the entitlement tends to be a stickler for a lot of people. If they currently have a home using their VA loan, then we have to release your entitlement. So a couple different options. One, you can sell your property prior to closing on the construction loan. If you sell your home, it will automatically reinstate your entitlement. Okay, selling your home reinstates your entitlement. So if you do that, you could do that option. Number two, you could have someone assume your VA loan, but you have to have a veteran assume your VA loan. Because if a non-veteran assumes your VA loan, then your entitlement is still stuck in that home, in that loan. And if they stop making mortgage payments, you could lose that portion of your entitlement. So I don't like veterans having non-veterans assume their VA loans. And that's a whole nother class, the assumption. And we'll talk about that. I'm going to do another live next week on Wednesday, and we're going to talk about refinances, cash out refinances, IRRRLs, interest rate reduction refinance loans. And we're going to talk about refinancing from a VA loan into a conventional loan, which was going to be another option I'm going to present to you. If you refinance from a VA loan to a conventional loan, you can request what's called a one-time restoration. You can do this one time in the history of using your VA loan. One time. So make sure you do it at the right time. And we can talk through that and kind of guide you to figure out what that looks like. But that is an option. You can refinance from a VA to a conventional. Now, the downside right now is conventional rates are great. And if you got a VA loan when rates were in the 2s and 3s or 4s, you're going to not love the new interest rate on your conventional loan. But if you're stuck on the idea of wanting to get rid of your VA loan, but you want to keep your house and turn it into a rental property, but you can't qualify because you need that 100% entitlement reinstated, then you can refinance into a conventional loan, do a one-time restoration, release your entitlement, and have 100% of your entitlement left to go to 650, 800, a million plus, whatever you want to, as long as you credit and income qualify. I always say that because I have people that are like, well, you can't go to $1 million if you don't have enough income. And I'm like, yeah, good point. And I know, I understand people are just processing information differently. So, but I'm reiterating those things so that you guys know that I'm not trying to like pull the wool over your eyes and say like everybody can do anything. No, you still have to qualify. All these things you have to qualify. Yeah, and some people have like 2% interest rates, and 2% interest rate is amazing, and you're not going to get a 2% interest rate on these loans right now. I don't have an exact quote because I have not, to be honest. I'm not actively originating loans anymore. I do more education and I do more social media and then running the company. I want my team to post an idea of what rates are doing right now for the VA one-time close. So they'll post it. Make sure you guys put an APR in there so that we're compliant. And that'll give you an idea of what that looks like. This video is also going on YouTube. So if you guys want to rewatch this video later on, please feel free to do that. Feel free to share it. Share it with real estate agents, share it with, any friends that you have that have served that want to know about the VA one-time close, because they just don't have the information. It's hard to find out there. And we want to make sure everybody knows that this program does exist. So not everybody's going to build a home. A lot of people get into this program and you think that you're going to build, and then you do the research and you dig in and then you meet with builders and then you realize, I can't do what I want to do in the price point that I want to do it. So then they end up finding something that's already existing, or they find a builder that's already building a home that's new construction that they can settle on until later on down the road. So everybody's in different phases of life. It's not going to be feasible for all of us to build something immediately in our lives at young ages. But if you can work it out, if it makes sense, if it's an affordable thing, if it's comfortable and it doesn't make you house poor, and you can invest in your future through building or just using your VA loan, we're all for it. And real estate as a whole is an incredible investment. We have built our wealth through real estate. We would not have, the equity that we have in properties if we hadn't taken risk. Real estate is risky. It can be, but it's the most stable kind of risk you can have. It's almost more stable than cash in the bank right now, you guys. And don't get me into that whole political conversation, but with inflation where it's at, people have to live in homes. There's a shortage of inventory. They're not making any more land. The cost to build continues to go up. Real estate is a safer investment than most things. And if you think back all the way to back in the early 1500s or 1300s, the landowners, the people that owned property and that had people paying them to live in that property, they were more wealthy. So the more properties you own, be smart about it. Don't overpay, don't buy the wrong properties in the wrong locations. But if you're smart about it and you're using business consultants who are professionals that do this all day, every day, and they know what the hell they're talking about, it's a calculated risk, right? You're educated. If you're here watching this video or watching this TikTok, you're educating yourself. So you're learning, you're understanding. And the more you know, the more knowledgeable you are, the better risk you're going to take, the better decisions you're going to make based on calculated risk. So I don't know. What am I missing? Income. How much income? I've seen that a couple times. Like, how much income do you have to qualify? A really broad, generalized statement, and do not, this is not finite. Under 60% gross income for your debt to income ratio. So you want all of your mortgage payment and any other debts that you have that are credit debts. So like your car loan payments, your credit card payments, your student loan payments, your motorcycle payments, your RV payments, like all of those things, plus your mortgage payment should be under, I would even say under 50% of your gross income. So if you're receiving VA disability pay, we can actually gross up your income, we get, let's say you receive $1,000 a month for VA disability. We can actually treat it like it's $1,250 a month because it's non-taxable pay. Okay. So any non-taxable pay, we get to actually gross up because all of your taxable pay, we're using your gross taxable pay. So that's really cool. And that's about a good figure. Now, have we gone higher than that? Absolutely. If you have good residual income and you have assets and you have good credit, and you have money in the bank and all these other things, yeah, the computer system will go, we've seen it go up to like 76% of your gross income. But textbook is not that. I would say under 50% of your total gross income is a good place to estimate that you need to be able to include your mortgage payment, including your taxes and insurance, so PITI, along with everything else. If you're tax exempt because you have a VA disability and rating and you're tax exempt from paying property taxes, now some states allow that tax exemption. Tennessee, Texas, Florida, California is working on it, and there's a bunch of other states. I can't remember them all right now. But if you have a tax exemption, if the county will verify that you are exempt from taxes up front, we can use that tax exemption to qualify you. So we can eliminate the property taxes to qualify if we have the documentation from your county. And some counties won't do that until after you become the homeowner. Some counties will do it in advance. So it depends on the county. If you have a VA disability rating of 10% or more, your VA funding fee is waived, meaning you do not have a VA funding fee. If you are a Purple Heart recipient and you're active duty, the VA funding fee is waived. So VA funding fee is financed into the loan amount typically. Most people do not pay cash for that. You can pay cash for that, but most people don't. I think that is the majority of the questions. Closing costs can be, somebody's saying, keep in mind, closing costs, which can be negotiated. You can't negotiate a lot of the closing costs on these VA one-time close custom construction because the title fees are going to be title fees. You know, the third-party fees are what they are. We don't charge extra origination fees or anything like that. We have one fee, and it's an underwriting fee. Otherwise, it's all investor fees specifically for the one-time close, and they're not very high investor fees. They're pretty low. So I wouldn't say that you can negotiate closing costs on this transaction. You might be able to negotiate to have the builder pay it in the contract. You could negotiate potentially to have the seller of the land pay some of your closing costs. So yeah, you could negotiate that. On a regular VA transaction, everything is negotiable, right? You can negotiate closing costs be paid for by the seller. The seller can pay towards debt payoff. The VA loan's freaking amazing, you guys. If you have not used your VA loan yet, I'm so glad you're on here because it's the best way that you can leverage other people's money. It is your money, but it's other people's money up front. It's the best way you can leverage that to exist in a home and be paying towards your future. So VA one-time close. If you have more questions on this and you want specifics and you want us to look at your specific scenarios, reach out to the team, VALoanBish.com, VALoanBish@VLGnow.com or at VLGNow. I think that's our email address. You can also call on the number 448-400-2429 or call or text. And we will get back to you and we will answer your questions and we'll make sure you have all the information that you need. We are doing a live next Wednesday to cover refinances, the VA refinances. So a VA cash out refinance, you can go up to 100% of your equity on a VA cash out refinance. Sometimes you could do that in advance and then buy land and then sit on the land for a while. And then a year down the road, you can build. We get a lot of people that say, can I just finance land? There is a VA land program in Texas, but that's the only state that has a VA loan program where you can finance land. Otherwise, let us know if you need a real estate agent. Let us know if you need help finding a builder, what questions you have. We're here to help. Thank you guys for attending this live. I'm glad you're here and hopefully you learned something new. Otherwise, like my page if you're not already following it, because if there's any updates to the programs or anything else that's coming up, I'll get that information shared with you. We're constantly posting new videos and new information, and we know what the fuck we're talking about. So that's cool. You won't have to go searching for someone who knows what they're talking about when it comes to VA loans. So thank you, everybody. Enjoy the rest of your evening.